So we have been dealing with the informal way of accounting so far, essentially how each of those financial transactions that happen, how are they likely to impact the balance sheet. But again, emphasizing again that this is an informal way of doing this. This is not the correct way. Hopefully by the end of today's class, I will also show you a more formal. In this book, there is a more formal solved example also. So if you can get hands on this copy, this is quite old book. If you can get hands on this copy, you will have access to that exercise as well. So please go ahead if you are really more keen about this particular course, right? So what we have seen so far is, again, the examples here are more from the manufacturing side. That's just because it's easy or this book was written. I do not have a specific example from construction, but again, these are a lot of standard notation, standard practices. So more or less, you will have similar accounting practices even within construction. Slightly different, but I will, if I find more examples, I'll share with you as a separate thing, right? So far we have seen three companies. First was a simple company. You borrowed, you put your own capital, you buy some stock, you sold that stock of cement to some profit, and that was the simple transaction that we saw. In second, there was a investment from the partner, essentially not as a loan from a partner, plus there was a banking loan. Again, you made a profit and you by selling the stock. In the third one, we looked at a little bit of the inventory and work in progress and that kind of a topic. So once you buy the raw material, that is a stock for you, and then you convert that stock to work in progress by adding the labor or putting some sort of a process through that raw material, so that it is no longer a raw material stock, but it gets converted into work in progress. Once again, you sell that and you get some profit that finally is shown as a retained profits in your balance sheet, right? This one is slightly more complicated, and I'll just giving you essentially these case studies. All these 6 companies are listed here: the brown company, the red company, the blue company, whatever. They are in the increasing order of complexity, like handling some of the transactions. And these are good examples for us to answer some of the common questions that we have been having so far. So that's why I'm referring to them, right? So our main character is back, Mr. Ramaswamy, serial entrepreneur, 4 months, 4 different companies. So that's a record. Either he's a terrible businessman, nothing works out, or he's like a serial entrepreneur. You can argue both ways. But essentially, he had been he had avoided business transaction that could complicate his accounting. So in the blue company, which is the previous company, he had carefully ensured that there were no part conversions of the raw material to work in progress. I'll come to this concept again. And then to work in progress to finished goods. What happened is there was a single transaction denoting that all the stocks got converted into work in progress, and that all the work in progress got converted to finished goods, right? But that's not how real world works. In reality, there are multiple such parallel transactions happening. So that makes your life a little bit more complicated. And that's something which we want to learn through this example, right? He was also conscious that he had not accounted for interest costs and depreciation. How do you account for depreciation and interest? I think some of you had asked these questions. How will I refer to a loan which gets some interest accumulated? How will I show in my balance sheet? As well as the depreciation amount, right? How do I show this? Nor he had paid a dividend. In all our cases, previously, we did not pay anything to our shareholders. But that's also a valid exercise that a lot of companies will do. Yesterday, I got to news that HDFC Bank made huge profits this quarter, apparently. And they had like a 12 rupees per share as a dividend given to a lot of their stakeholders. So I did not get the money, but apparently in my entire portfolio, I own 5% of my money is gone into HDFC. Maybe it will be reflected in my account somewhere if I go deep down. But essentially, every company, this is the quarterly results. A lot of companies will announce that, and you will hear, okay, this company paid so much to their shareholders and so on. So it's a valid exercise. Even construction companies do that, right? So, and then there is an income tax, which we had not accounted for. So essentially, this example is a more complicated example from the previous one, just adding these 3-4 dimensions to it, right? So in this case, Brown Company is the name of the company. He started with a capital of 3 lakh rupees. to produce cheap trousers. Again, he's still in the business of making jeans. On August 1, the company, are we going back in time? August 1, it seems like we are going back in time, but essentially, it could be next year. The company used this capital for and a rupees of 4 lakh bank loan to buy a building of 1 lakh, equipment for 250, furniture worth 50,000. The company also bought 1,50,000 worth of cloth, enough for 3,000 pairs of trousers. Okay. You opening balance sheet, we will need to, before we even go to any transactions, we are first filling opening balance sheet. In the opening balance sheet, what is the liability side? How much is the capital? 3 lakh rupees. Any loans? 4 lakh rupees bank loans. Anything else in liability side? No. Asset side, what are the assets? Building worth 1 lakh. Equipment 250. Furniture worth 50. Okay. And cloth is going as stock of raw materials, right? Anything else in the opening balance sheet? Cash. Should it come or should it not? You have total invested 7 lakh rupees. You have 1 lakh, 250, 350, 4 lakhs and 550. So what's happening to the remaining? That's in your bank account, right? That's your cash. So this is the opening bank. This is essentially your opening balance sheet. Buildings worth 1 lakh, equipment worth 250, furniture worth 50, stock of raw material 1 lakh 50, work in progress, so far it's 0, there is no transaction, cash worth 150. So the total is, how come total is 730? Okay, sorry, this is, they have already converted this to this transaction, they have already accounted, that's why it's coming. But I'm just giving a previous idea, before the transaction occurs, that's the kind of thing we are taking. So there's no accrued wages for us right now, only the capital and the bank loan would be there, right? Let's go back to the, it's so slow. The first transaction. So each pair of trousers require 50 rupees worth of cloth and 30 rupees worth of labor, right? These have been given to you. The workers' wages for August had to be paid by September 7. This also is given to you. Work started on 2,000 pairs of trousers. By August 5, these trousers were half complete in terms of the labor. So we are showing the, after the transaction, we are showing the balance sheet. So what happened to the raw material? How much raw material is gone now? 50 multiplied by 2000, it's about 1 lakh rupees. 1 lakh has gone from the original stock of raw materials to work in progress. At the same time, there is a, what is the additional component of work in progress? The labor, right? So each gets 30 rupees worth. It is only done half. So it is 15 rupees worth for how many pairs? 2000. So total of 30,000 rupees is in your wages. But this much you have not paid. So this is going on the liability side of accrued wages, and your total work in progress becomes what? 1 lakh plus 30,000, which is 130. And your raw stock goes lower by 1 lakh rupees. Making sense? So this is the sheet that we just saw. Originally it was 150, it's got subtracted by 1 lakh. Stock work in progress is total 130, and you have corresponding 30 as accrued wages. So material 2050, this calculation is easy, simple to understand for all, hopefully, right? And this accrued wages concept. On August 10, by August 10, the Brown company completed 1500 pair of trousers. 500 pairs were left half complete. How does this affect your balance sheet? What is happening to raw material stock? Any changes? That was already accounted for in the previous one. So out of the 2000s that you were making originally, now 1500 have been completed. They have moved to stock of finished goods. But what is the change in value? Labor. For 1500 multiplied by 30 rupees, the remaining 30 rupees. No, the total labor was 30 rupees. So remaining labor is only 15 rupees. Whatever that money comes out to be, that is going to be the stock of finished goods. The remaining still remains in the work in progress, right? So this happens to the work in progress. It goes down by 97,500. Awkward numbers started coming. So far we were dealing with nice rounded figures, but now all these fractions are coming up. And the total stock of finished goods is now 1,20,000 rupees. If you add the total, it will come out to be 7,52,000. Correspondingly, there is a additional accrued wages, which is on the 22,500 rupees. The total liability still remains 752,500, right? The explanation of this transaction is here. The work in progress stock 550. This is still there, percentage completed wise. Labor 530, percentage completed. So this stock, finally it has to remain 32,500. So you subtract such that it remains 32,500. The stock of finished good, material wise 1500 unit, 50 rupees, 100%, 75,000. Labor wise 1500, 30 rupees, 100% complete, 45,000. The total money comes out to be 1,20,000 rupees here. Making sense? Basically, we are shifting money from one to another, and in each time there is a value addition worth of labor, and that labor you have not paid yet, so it's actually shown in the accrued wages for your liability side. Clear? Okay. Transaction 3. By August 30, the Brown company had sold 1000 pair of trousers at rupees 120 per pair. Okay. The buyer agreed to pay by September 15. No further manufacturing took place after August 10. Any changes in your asset side? In your stocks of assets? Raw material? Any changes? Work in progress? Any changes? Yes or no? Finished goods? It reduces by how much? 1000 pairs. Pairs is the unit we are putting in balance sheet. 1000 times 50. What 80? What is 50 plus 30? So how is that changing? That's the total amount getting subtracted from the finished goods. Okay. What is the cash? Which is 1,20,000. Is it higher than your cost? So correspondingly, profits have to be there, which will affect what? Liability, and there's a real cash in the money, cash in the bank, right? Has it come? So how come is it affecting cash? Debtors. So there is an increase in debtors because you have not gotten the payment yet, but you will get this 120 into whatever 1000 pairs you have sold. So this much money you are going to get in a debtors account. You have sold this 1000 into 50 plus 30, so which is 80,000 worth. The 40,000 is going to be your retained earnings, which is you have to show on the liability side as well, right? Already getting the feeling that it's going to be complicated. You can imagine. And we are just dealing with one single assembly line of just making jeans, right? Imagine a company of clothing company having stocks of all sorts of different SKUs, which is called the unit, the lowest possible units. You have thousands of design. You need to track stocks and inventories of each of them because you want to make decisions whether a particular stock is easy to sell or not and things like that. So this exercise is easily 10,000 times more complex you can imagine in the real situation. right? But again, these are pretty standard mathematics, so therefore it helps to have such uniformity, but very much scope of making mistakes if you do this manually, right? Any doubts here so far with me? All right, let's go to more complex transactions then. Yeah. If they pay. If they pay. Not obviously. We'll see that example also. It's not always that you get your money paid back. These businesses have real risk of not getting paid on time. Cash on delivery, particularly the online businesses, have this risk very, very much real. If you want, go to newspaper, read the stories from certain people will beat the delivery guy, not pay, whatever. Thousands of things can happen. It can become very complicated very quickly, right? Okay. So, this transaction, do you require any thing here? It's fine, understandable. So, but notice this retained earnings that we have put right now is essentially before taking into account of anything related to taxation, depreciation and other things, right? This is because we have not accounted for that. This is how this particular transaction will look right now. On August 31st, oh my god, this transaction is so big. On August 31, Ramaswamy paid 4,000 to the bank as interest for August month's 4 lakh into 12% per annum. So he paid 4,000 rupees bank, the interest to the bank. Wanted to prepare the August income statement. So in addition to material, labor and interest, you also have to charge depreciation of 6,000 rupees on the fixed assets that you had. You had several fixed assets, right? You have building, you had furniture, you have equipment, all that has some depreciation to compute the profits before tax, right? On this profit, you have to pay income tax at the 30%, which I suggest you pay this morning. You can also pay 5% dividend on the capital of rupees 3 lakh. So suddenly there is a lot of transactions happening towards the end of the month. There is a depreciation, there is an interest that you need to pay, there is a taxation that you need to pay, and there is a what more? The dividend you need to pay, right? So how do we handle this? You have to prepare an income statement after this transaction. That's what they are saying. So we will first look at the income statement. So your sales in this period was 100,000 pairs at 120 rupees, which is 1,20,000 rupees. Your expenses on material was 50 rupees into 1000 is 50,000. Your labor charges for 30 rupees into 1000, 30,000. Your depreciation, 6,000 rupees. Your interest, 4,000 rupees. These are actually real costs. You need to subtract them. So your profit before tax is 30,000 rupees compared to the original 40,000 that you had shown in your previous balance sheet. It is actually 30,000 rupees, not that. And this is before taxation. Now you have income tax at the rate 30%. So your profit after tax is 21,000 rupees. Right? Now you are making the dividends at the rate 5% on the capital. Capital is what? 3 lakh rupees. 5% of that is what? 15,000 rupees. So that is your dividend. So your finally net retained earnings is 6,000 rupees compared to the original 40,000 that you had put in your balance sheet. This is what happens in reality. 6 out of 40 is what? 15%, 16%. That's a huge profit margin actually. If you see, that's still a very huge profit margin. But you see lot of pies which take into account of that the 40,000 that you originally. So that's why the markups, that's why you need to have, like in a raw sense, you need to have really 40-50% profit margin levels, which is called gross margins or gross profits. And then all this taxation, depreciation you do, then your pie remains really, really small. So that's how the cost actually gets sold. It's too much. If you see 6,000 over to 40,000 is a net profit which you could have originally gotten, right? How does this transaction actually reflect in the balance sheet is shown here. So we just have to fill up the balance sheet in this. So notice there are several new accounts being created. Building no change. Equipment, no change. Furniture, no change. Gross fixed assets. What is gross fixed assets? No, why are we showing them separately? I'll have to check. What is this? Okay, but your accumulated depreciation. This is a new entry on the asset side. That depreciation has been there because the purpose of depreciation is you will right now keep it so that you later on invest, right? So this is a money which is not going out of your system. It is still, so therefore it is an asset and therefore it is shown in accumulated depreciation of 6,000 rupees. Your net fixed assets, okay. So yeah, these are essentially the sums, which also happens. Ideally, they should have shown it using a slightly different header, but maybe in a simplistic manner they are showing, but these are in fact summation. So net fixed assets is your total fixed assets minus the depreciation. Your raw material goes work in progress, same. Your debtors and cash is nothing changed there, right? But cash has gone down by 28,000. We will look into it, how it goes down by 28,000. Okay. But on the liability side, your retained earnings was originally 40,000. Now it has been reduced to just 6,000. We already saw how did that happen. Bank loan, there is no loan, but if the interest you did not have paid, then that would come also as an additional liability here, right? Accrued wages, you still haven't paid your wages, so that is still reflecting in your balance sheet. How does it come? This particular value you can see here. So your accumulated depreciation, gross fixed assets, the total purchase value of all fixed assets. Accumulated depreciation is the cumulative value of depreciation on fixed asset treated as an expense in the income statement. The Brown company started in August and the depreciation expense of August is the cumulative depreciation expense. In September, for instance, the depreciation expense of August and September will be accumulated in the same account, right? So you just keep on adding this, right? Your net fixed asset, this is the net value of your fixed asset. The value is obtained by subtracting the accumulated depreciation from your gross fixed assets, right? The cash, 28,000 cash is paid out, 4,000 in interest, 9,000 in income tax and 15,000 in dividends. So this is reduction in your cash account, so that becomes 28,000. Your total assets, the total of net fixed asset, stocks, debtors and cash. Okay. Retained earning at the end of the transaction 3 is, so previously these were tentative retained earnings, so typically they are denoted by a star, but again that is only for internal purposes because typically when you release these statements for public consumption, you do all this calculation and then only you do. So you always show the net retained earnings. Therefore, this amount it reduces by 34,000, which is the interest, the depreciation, the tax and the dividends that you have paid. So finally this amount is only 6,000 rupees. Okay. So the step of showing the retained earning as 40,000 in the first and then finally reducing it to 6,000 is just for your explanation. But the previous 40,000 ideally would never make it to the final balance sheet. Final balance sheet will always have these taxation, depreciation taken into account, right? So that was just for your clarity. Okay, getting a little bit complex. Want to go more complex or you are done with accounting now? I'll show you one more example because we have taken that here. That question has been raised here. Is it moving down or not? So slow. Yeah. No, we are not returning the capital to the owner. We are returning some profit to the owner. His 3 lakh rupees, his or her 3 lakh rupees are still in the company. We are not returning that. Just the additional income that we had, we have removed some fraction of that, we have paid it back. But we have not given the original 3 lakh rupees. Yeah. That will stay. If you go into loss, you need that money. Right? So that always happens. So the original investor will never get their 3 lakhs back as such they will always get share from the profit such that they recover whatever the money they had originally invested plus whatever their expectation of interest was for 3 years, 5 years. If the company is paying out, they originally had expected something. But if they remain invested, then they are always there, right? So that part is always there. Okay. In a way, yes. But just because you have paid them more than 3 lakh rupees, let's say, does not mean that they are still not invested in company. They are still invested because they paid the 3 lakh rupees. So if you start reducing from the capital, then after maybe 10 transactions, you will say, now you go out, we have paid you enough. That's not how it works, right? If they want to like sell their stake, then on that company's worth on that day, they make another transaction that, okay, my original 3 lakh rupees are now worth this much and I'm selling it to the next shareholder, and the next shareholder will come. But just because they invested 3 lakh and in the profits they have earned more than 3 lakh rupee does not mean that they are no longer invested in the company. They are still invested in the company, right? But if they want to take an exit, then they need to sell their stock, which is whatever the 3 lakh rupee they had originally invested, whatever is currently worth, which is called the market valuation and all those things. The new investor will pay, and that money will be used to pay the original investor's capital amount. Right? Got it? Clear? All right. So the red company, what happens to the red company? Can you guess? So far we have been making profits. Loss. So we need to at least know how to account losses in your balance sheet and how do they account, because unfortunately the world is not as rosy, always making profits, especially in construction industry or in pair of making jeans. I'm pretty sure not so much money. But let's see how does the loss gets into accounted into all this balance sheet, because you asked this question, so it's there. All right. So the beginning of a red company. It was a wonderfully pleasant September and Ramasamy was in an optimistic empire building mood, like, yes, I can conquer any business. Only a small time operator believes that a free market is a free market. An entrepreneur like me has to learn to corner the market. So he is like, now I am the big bully. I will derive the conditions and I will do whatever I want. Basically, I am the major player. And I intend to start with the bullion market. Do you know what is bullion market? Business of actually selling gold and silver, not for your jewelry, but essentially the pure carats, the gold bricks and the silver bricks kind of a business. So this, which is the rates that you get in your most of newspaper also you get, okay, this is the 10 carat gold price today, whatever, that is the bullion market, right? In current world, that has also converted into a paper based most of the time. There is no actual somebody is transacting gold bars to one another, but there is a bond equivalent to a gold bar and that gets transacted in global world also, right? But for bullion market, there has to be an equivalent physical gold somewhere backing it up, always. That's the condition, right? So bullion market, so September 1st, Ramasamy founded the red company with an initial capital of 2,25,000, all his own. He's getting confident that I don't need other people to invest in me, I am okay. He refused to let his friends subscribe to the capital. The profits are going to be truly mind-boggling and it will be all mine, right? Of course, it will be all mine. The same evening, the red company bought 175,000 worth of silver for his cash. His wife was a bit doubtful. How can you corner the market with such small stock? His wife is the most financially educated person in this whole thing. Definitely for just 1,75,000, you are going to corner the bullion market. Definitely not going to happen, but that's the intention, right? So after this transaction, how is the balance sheet looks like? Pretty simple. What's happening? There is a capital, there is a cash, there is a stock, all these pretty standard things, right? Who wants to wake up in the middle of the class? So your stock, cash and your total liability. This is pretty okay. I hope all of you are fine with this transaction now. luck favors the brave, but not for Ramaswamy in this particular case. The government, frustrated over having nothing to do to regulate, decided on September 3 to control silver. Silver stocks could only be held by authorized dealers, and Ramaswamy failed to get a license. On September 4, he was forced to sell his entire stock of silver to honest traders for 1,25,000 rupees. The buyer agreed to pay in a week's time. How much was the original? 175. He did not buy a license, so you are no longer in the business. So whatever you do, you sell at the earliest possible, not immediately, right? Now the buyer is dictating the condition that I'll not pay you immediately, and therefore 1,25,000. Immediately there is a loss or a profit. Immediately there is a loss. So how do you show that transaction of a loss? How do we show profits? Retained earning on the liability side. Where should the loss go? Liability side or asset side? Profit is going on liability side. All of you agree. Where does the loss go? Why does it go to assets? We have to. I didn't understand. Capture the losses at that point of time. Okay, your answer is correct. Your explanation, I'm not sure, but yeah. So this is where it's just a matter of convention, is that losses are showed on the asset side rather than decreasing the liability side of it, right? So this is just a financing, again, accounting principle that you have to know, otherwise you will get this transaction wrong. But essentially your stocks have depleted, 175 totally gone. Your debtors have come to 125,000. Your cash in the bank, no changes. Your loss is shown on the asset side with 50,000. Your total is 225. Your capital is still 225. There is no change in retained earnings, or you are not reducing the capital. Essentially, you are accounting it into a loss scenarios. Why? They also provide a very simple explanation. So the red company had suffered a loss of 50,000 on this deal. Just as the profit belonged to the capital suppliers, losses are also borne by them. Had the company made of a profit of 50,000 on this deal, it would have owed 275,000 to the capital suppliers. Since the company has actually made a loss of 50,000 on this deal, it now owes 175,000 to the capital suppliers, which is essentially the initial capital minus the loss, right? Just as profit made was shown separately as retained earnings, and they were not added directly to the capital or subtracted from the capital, losses are also not reduced from capital but separately as loss, right? So retained earning is not directly modifying your initial shareholder value. It is shown separately. Similarly, loss also receives a simpler attention. It should be properly reflected. It is possible to reduce this loss from the liability, but the accountants usually do not like subtraction, is their logic. But it's also fair, because when you are adding everything, you just change the notation of a meaning, so that the meaning is negative, but still you are doing the calculation as an additional manner, so that there are no lack of consistency in the process. So you are always adding up things, and that's the simpler, to keep it simpler. Again, why? Because we are dealing with just one transactions. In reality, they are dealing with millions of millions, and that becomes the problem. So it's, instead of deciding what, you make your principles such that everything is always simple addition, no subtraction, right? That's why the usual practice is to add loss as an asset side. So you just need to know this in order to do this transaction. Otherwise, there is no, you would easily get it wrong. So luck had run out for Ramaswamy. On September 10th, the honest traders paid 1 lakh and made it clear that that was all they could pay. So you had a question, if you are expecting to get paid, you will get paid. Not necessarily. They were broke, the other honest traders were broke. So originally you were expecting 125,000, now you are getting only 100,000. right? So how do you show it again? Debtors gone down by completely 125,000. Your cash has increased only by 100,000. Your loss has gone up by 25,000. The total is 225. The total liability is still 225. Okay, make sense? Then this is your profit and loss statement. Your sales was 125. Your bad debts and everything, and your total loss is 75,000 rupees, which is the P&L statement. There is also, yeah, so the next I am not going, but there is a little bit more complicated example called the Orange Company. Find the book, read that. That's going to be cumulative of whatever we have seen so far into a like single transaction, and therefore it is a little bit complicated to understand. But that, take it as a practice for you if you can get hold of this book. If you don't get hold of this book, let me know. We'll try to arrange for sure. The physical copies definitely we have here and there, right? So that brings us to the end of this informal way of doing in this accounting practice. I also wanted to show you one last thing before we close this whole discussion, which was about the, so this book then also has a lot of interesting things other than the simpler accounting principles. Then they go into explaining more complicated and formal procedures also. So then you can also have a detailed understanding, and they provide very interesting explanation of why a particular transaction is going in what manner and blah blah blah, right? And I'll just show you one more exercise of how do we make the, I have mentioned something called closing of T accounts, right? In the formal process, there was something called closing of T accounts. Essentially what happens is, you first initiate the transaction, you register them in cash book or journals. Based on that, you put them into a some sort of a T ledger. In T ledger, you have to close the T ledger after a certain point of time. That procedure of what do I mean by closing the T ledger is something that I'm going to show you today, just as a simpler example here. So, yep. So essentially, this is how they do. So imagine this was certain transactions. I'm not going into again detail. We have already seen this transaction, the T5, the first sales versus profit kind of a example that we saw. This is the same example, but I'm just showing you how to close the T account, right? So originally in your T account, this is a cash type. Your T1, T2, T3 and T4 were which actually occurred. And then there is a T5A which is shown here, right? So these are the transactions which we already saw. They exist. Now when I say they close the T account, what happens is you start taking total on both the sides. Okay. So if you take the total on both the debit and the credit side, 1 lakh, 50,000, 12,000, total is 162, right? But on the credit side, your total is only 35,000. So in order to match the total, what you do is, wherever the difference exists on whichever side, for example, in this case, debit is more than the credit. So you add an entry called balance carried down on that side. So the remaining amount of 127 is termed as balance carried down. Okay. So the total of this now becomes 162 and 162. And then the opposite side of the balance carried down, you write another entry which is called balance brought down, which is essentially the same on the opposite side. So net is still same. You are still doing the same. Ultimately, you are claiming that your debit is more than credit in this particular account. But just to make it consistent, they have this method so that they can check individually which T ledger has a problem later when they have to rectify everything. So this statement, when I say you have to close a T account, you take the sum of both debit and credit side. Wherever the sum is lower, you make additional entry called balance carried down. The remaining goes there so that the total of both debit and credit is always equal. The opposite side, whether if the original balance carried down was on the credit side, on the debit side, you write an equivalent entry called balance brought down. Or if it was in the debit side, you write an equivalent entry on the credit side, which is balance brought down. Okay. So this is what I mean when we say formally close a T account. This is the process that they do. It has some advantage in a way that then you don't have to individually read all the entries in the table in a T account. Then you can just note down this value and then quickly pick up to make them in your trial balance or whatever you are picking up, right? So this is the formal process, nothing too significant, but essentially yes. So you see in this side, the capital liability account, you had a cash transaction worth of 1 lakh rupee. There was nothing equivalent to that in your left hand side on the debit side. So you write a balance carried down 1 lakh rupee. On the opposite of balance carried down, you have a balance brought down entry, which is 1 lakh rupee. Clear? You can ask, why sir, why are we doing all this? But essentially what then happens is, you can simply pick up these lines. This is your initial trial balance. You have debit and credit side on the trial balance. You just put the name of the account. So cash account, your cash account had 127 on the debit side. So you directly transferred to the initial trial balance. Your capital liability has a credit entry of 100,000 that immediately comes there. So that's the idea of making the trial balance calculation will become easier. Your cash account 127 on debit, capital bank loan 150,000, building stocks, cost of goods sold, sales, all this come out to be total. So this is an initial trial balance. Again, your total debit equals total credit always. These checks and balances are there so that when you backtrack, you know where exactly the problem was. Then you can figure out which transaction is not adding up, go to that T ledger, go to the corresponding cash and the journal entries and figure out where exactly the problem was. Where did the error occur? To simplify all this process, they have to do this. Okay. So we'll just finish this topic here.